Hi there, and welcome to the Everyday Entrepreneur Podcast, where I, Kaitlin Fritz, help you reach your entrepreneurial potential. Together, we can build your dream social impact business so that you can leave a legacy beyond your 9 to 5. Hello. Welcome to this week's episode of Everyday Entrepreneurship. I am your host, Kaitlin Fritz. I'm a Forbes recognized entrepreneur, business mentor, and enterprise educator who's helped businesses across the world build, grow, and scale with impact. I am thrilled to be with you today. I can't believe we're already at the end of September, but also secretly excited because I am one of those weirdos who will not buy a pumpkin spice latte or eat something deliciously pumpkin until October. So I hope all those chilly mornings and evenings you're enjoying more pumpkin spice than me. So to put all of my very basic coffee desires aside, if you listened to last week's episode, you know what we are talking about this week. It is costs. Whew. Oftentimes, when I speak to founders, they get a little squeamish when we are talking about costs, their financials, and some of their pricing strategies. And I've been there. I don't have professional background as an accountant. I did all of my early cost analysis on Google Sheets and Excel. But when it comes to cost, it's really important to understand that they are make or break in your business. Because as a business owner, you need to know when you're going to be profitable. Now, many times you hear startups and businesses use the term revenue generating. You can generate revenue, i.e. you're making money, but not be profitable. And I want you to have a business that not only aligns with your purpose, but also builds that profit in the bottom line. So I wrote this article, I want to say a year ago, back in 2022, on Startup Stash on Medium, where I walked through a case of an individual starting their own small business. What they were doing is creating a spice kit that was mailed out every month as a subscription. And I called it the ABCs of startup costs. And I'm going to give you a high-level overview of what I mean by ABC of startup costs. So let's jump into A. A are the actual costs. So these are the things that you actually incur. What does it physically take for you to produce one unit of your product or service? So I like to think about these as like tangible materials. So maybe it's paper, plastic, hopefully not plastic because we don't need any more of that in the world, cardboard boxes when it comes to the spice kit, as well as the time it takes for you to create your product or service. So if it takes you 10 minutes to make one spice box, you need to be able to calculate that in. So actual costs can include things like raw materials, packaging, mailing, if you are including shipping, because Amazon has really spoiled us in that, and time it takes per product. Now, actual costs I feel like are very easy to measure because they come in and out of your bank account. You can probably scroll through your transaction list and see those costs. And oftentimes, when we think about costs, there are fixed and variable, which we will discuss when I talk about point C. So that's point A in the ABCs. Point B is building in your margins. Once again, what separates a business from a hobby is sustainable profits. So you need to build in profit margins, i.e., that gap between your costs and your selling point. And profit margins really vary in each industry, section, and business. So some industries might have 40, 50, 60% profit margin, whereas others might have as little as 5 or 10% in the beginning. And it's important to know what your profit margin is. If you have absolutely no idea where to start, I recommend building in between 20 and 40% for your profit margin. That will keep your business healthy, especially while you are testing out your MVP. And in the article, I actually provide a Google Sheet for you to play around with for these profit margins. Now, that's point B. So we have our actual cost as point A, building in margins as point B, and here is C, more costs, but the more is silent. So C is costs. Like I mentioned earlier in the episode, there are fixed costs and there are variable costs. I am not going to go into the technical lingo. I'm just going to share with you the ways I understand it in a very digestible format. So when you think of fixed costs, think of things that do not change whether you produce 1 unit or 100 unit. They include your overhead and any costs you undertake no matter how many products you create. So in the example of the spice kit, no matter how many subscription boxes they sell, they will probably still be paying for an accountant, legal fees, storage unit, office space, etc. Fixed costs can be silent killers in your business. I mean, don't get me wrong, it is lovely to have a great co-working space, but I do not pay 300, 400 pounds a month of fixed costs in my business because, those are 300 or 400 pounds that I could be reinvesting in making the business better. Now, variable costs, like the name says, vary depending on how many units you produce. So, for example, that is why when you make 1,000 spice kits, the cost per unit is cheaper than if you make 1 spice kit. So those vary. So think of things like packaging. Some of those earlier costs we talked about in the beginning of the show are probably the variable costs you are thinking of. Now, when it comes to costs, there's also some hidden costs. So oftentimes, founders forget their time should be baked in to the price of the product or service being sold. Do not forget your cost of time. If you were doing this for free, it's probably not going to be as sustainable of a business. So point C is more costs. So we have A, B, C, and now we're going to go into D because I completely want to expand the alphabet of costs. D is don't immediately discount. Once again, I've been guilty of this. I'm pretty sure 9 out of 10 of founders I've worked with has been guilty of this, which is undercutting their prices at the beginning. Maybe you run a discount because you want to have more reach, but discounting can create cash flow issues in the long term. Once again, if you discount below your costs, then you are really going to struggle when it comes to breaking even, becoming profitable. So do not be afraid to charge market value or even above market value. I highly recommend you should be, like we talked about in point B, which was building in your profit margins, be selling at a point that is more than your costs. And last but not least, because I love the cost alphabet, E. E is evaluate the market. Sometimes we are so busy looking at our own Excels and spreadsheets that we do not see what the market rate is for the product or service. Remember that your business is providing benefits to customers. And these benefits have a price. People are willing to pay for them. So, for example, 1 hour of a lawyer might cost $400 in the States because you are paying for their education, their expertise, as well as their time. So when it comes to the spice kit example, it's important to recognize what are spice kits going for? Are there luxury market for them? Are they mainstream? Is this the Tesco price or the Waitrose price? You need to have research, both from online research or book research, I like to say, as well as having customer primary data. These will really help you when it comes to evaluating the accuracy of the market. Now, these are just some preliminary understandings of costs. So in this episode, we talked about the ABCs of costs, which include the actual costs, the building in of profit margins, more costs like fixed costs and your time. Don't immediately discount when it comes to your pricing, especially after evaluating your costs, and evaluate the market. I'll provide a link to the article so you can have a play around with the Google spreadsheet, but I encourage all of you to just step back, take a look at all of those costs, see if there's any hidden fees. I'm telling you, it's like Netflix, but in business, there's probably a subscription you are paying for that you do not need. As we're starting this, fall, autumn season, have a look, do an audit of your costs, and, get rid of any of those costs that are no longer necessary. Because I'm telling you, the leaner you can run, the more money you can invest into your business. So this was just a whistle-stop tour through the various elements of costs you might be facing in your business. And I'd love to hear from you. What costs do you find in your business that are variable or things that you can't change? Or maybe you're looking for a better alternative. That is what this podcast community is all about, because we are everyday entrepreneurs. And I would love it if you could leave a review and follow wherever you listen to podcasts. October is my birthday month, and for my birthday, I am looking for more reviews because I love getting your feedback. And, if there's any ways I can improve the show for you, that is my goal. So I look forward to talking to you next week, and give us a follow or review wherever you listen to podcasts. Thanks for listening. And until next time, this is Everyday Entrepreneurship. Thank you for joining me for this episode of Everyday Entrepreneurship. To stay tuned and most up to date, subscribe wherever you listen to podcasts. You can follow me, Kaitlin Fritz, on Instagram. And if you have any questions about building your business with impact, drop me an email with the link in the show notes. This podcast is produced by the great people at the Podcast Boutique. I look forward to catching up with you next week. See you then.